We are now going to discuss the accounting equation and do some transaction analysis. The accounting equation is assets equals liabilities plus equity. In our case, it'll be owner's equity. This is the basic accounting equation. We'll expand upon it more in a moment. First, let's discuss what each of these items mean. Assets are resources a company owns or controls. This is our stuff that the business needs to have in order to make sales. You, as a person, have assets. What would your assets be? What is your stuff? Here are some examples of some assets that you may have: a car, a house, your clothing, furniture, computers, phones, TVs, other electronics, and cash in your bank account. Now, let's go over assets that a business would own. They have cash, supplies, equipment, building, automobiles, and furniture as well. A lot of these are similar to your assets. Another one that businesses have that we will be dealing with a lot over this course is accounts receivable or receivables. A receivable is when we are owed money. We're going to receive money, which is why it's called a receivable. For now, we're going to assume that if anyone owes us money, that they will pay us. We will learn in a later chapter what happens when they don't. Next, we have liabilities. Liabilities are creditor claims against our assets. These are our debts and obligations. This comes from borrowing money. What are your debts? Some examples would be student loans, a mortgage if you own a home, your car if you financed it, your phone or computer if you're making payments on it. Do not confuse liabilities with your expenses. I have a lot of students who think that items such as an electricity bill, for example, would be a liability. That is not necessarily the case. I didn't borrow any money. My bill comes in, then I pay it. It's an expense, which we will talk about more later. Now, if the bill comes in and I don't pay it right away, then I will owe money and then it's a liability. There's a difference between paying something and owing on something. Now, for businesses in accounting, we call liabilities payables. Lastly, we have equity or owner's equity. In accounting one, we were only looking at small businesses, not large corporations. We will look at accounting for large corporations in accounting two, where these account names will be different. Equity is the owner's claim on assets or net assets. Equity increases through owner investments and revenues. It decreases through owner's drawings and expenses. This is sometimes a tricky topic to understand. I like to rearrange the accounting equation to explain this a little bit better. Instead of assets equals liabilities plus equity, I moved liabilities to the other side. So now it's assets minus liabilities equals equity. The equation does still work. But let's say I bought a car for $25,000. I put a $5,000 down payment on the car. Therefore, I owe $20,000. So I have a car right now that's worth $25,000. I put $5,000 down and I have a loan for the other 20,000. My car is an asset. It is worth $25,000. The loan, that's my payable, that's my liability. I owe $20,000 on the car. When I subtract the two, I get $5,000 as my equity, which makes sense because that was my down payment. Out of the $25,000 worth of assets that I have, I only own $5,000 of it because the rest is my debt. That is why equity is also called net assets. It's a portion of my assets that I own. We are going to expand on owner's equity more next. This is the expanded accounting equation. We still have assets on one side equaling liabilities, plus we're going to add everything that makes up equity. We're going to still have our equity, but we're expanding upon what is part of our equity. Equity includes capital. Owner's capital is the owner's investment in the business. If I put my own money into the business, my capital account will increase. Each owner will have their own capital account. For example, mine would be Kroger Capital. Now, all these next items affect capital. First, it's withdrawals. This is when the owner takes money out of the business for personal use. This could also be the owner paying themselves for work, such as taking a salary. If my business made $200,000 this year, you better believe I'm going to take out some of that money to pay my bills. This brings me to my next 2 points, which is revenues and expenses. Revenues are the gross increase in owner's equity resulting from business activities entered into for the purpose of earning income. That's the definition for it. Your revenues would be your earnings from your job if you're looking at, what your revenues as a person would be as an individual. A business's revenues are from selling a product or service. These are its sales. Expenses are the cost of assets consumed or services used in the process of earning that revenue. What would your expenses be this month? Sure, it's utility bills, food, gas, any of these other payments that you have to make each month. A business has similar expenses. Some examples would be a utility expense, which would be your heat, your electricity, gas, water bills. A phone expense, salary expenses to pay its workers, rent expense, and so on. The difference between your revenue and expenses is your net income, or loss if you lost money. A business will add up all its sales, then subtract all its expenses to arrive at net income. We will talk more about this in the next video. When our business has income, it will be added to owner's capital. Then the owner can withdraw it out if they want to, or they can keep the money in the business to grow the business. Sometimes the concept of equity can be really confusing. So if you are a little confused, that's okay. This is only the first lesson. Usually by chapter 4, students start to understand it much better when we close the accounts into capital. Enter the impact of each transaction on individual items of the accounting equation. We have 5 different scenarios that happened, and we need to fill in the chart here. First, we have part A. The company completed consulting work for a client and immediately collected $5,500 cash earned. We completed consulting work and we got paid money. We have to think what 2 accounts are going to be affected here, because we always have 2 accounts that are going to be affected in order to make the accounting equation still equal. Remember, we have assets on one side and then liabilities and equity on the other side. And I put a few specific account names in here, such as accounts receivable and accounts payable. By the way, this is how we list accounts receivable and payable. We do an A/R and an A/P. So it means accounts receivable, accounts payable. Now, we got cash, right? We got $5,500 in cash. Why did we get cash? Why did someone give us money? It's because we made a sale. That would go under revenues, $5,500. The accounting equation works as everything on the left side of the equal sign needs to equal the right side. 5,500 on the left side equaling 5,500 on the right side. Next, we have part B. The company completed commission work for a client and sent a bill for $4,000 to be received within 30 days. This is different from part A. We did work in both of these in part A and B. In A, they paid us right away, and B, they're going to pay us later for. Instead of receiving cash now, they're going to pay us later. What account do we use when someone owes us money? Remember, that's accounts receivable. So in this case, we did do consulting work, so we have earned our revenue, but instead of receiving cash, we have an account receivable. Someone will owe us money. In this case, instead of cash going up, accounts receivable will increase by $4,000, showing that we are owed this much. Why does somebody owe us money? Because we made a sale. See how revenues increased for both? but it's different over here. The accounting equation still works though. 4,000 on one side, 4,000 on the other. Then I have this darker blue line where we add everything up, 5,500, and then add up, this column is just 4. I have 0 for these accounts. Add up the 5,500 and 4,000 to get 9,500, and we have no expenses. This is just to make sure everything on the left side equals 9,500, everything on the right side also equals 9,500. Next, we have Part C. The company paid an assistant $1,400 cash as wages for the period. What two accounts are being affected here? For one, we're spending cash. Our bank account is going down. We're losing cash. Why are we spending cash? What's it going towards? It's going towards paying one of our employees, the assistant. It's going towards a salaries expense. So in this chart here, you would subtract $1,400 from cash because it's going down in value. And on the other side, we would put into expenses 1,400. The equation still works because this is negative 1,400 equals minus 1,400 here. So it's also negative 1,400. Now in chapter 2, we're going to be doing journal entries. We wouldn't just call this expense, we would call this a salaries expense. We would be a little bit more specific. But in terms of just getting you started here, we'll just group all expenses together. Now we're going to have to total these up on this darker blue line. We had 5,500 in cash. We just spent 1,400. So now we have 4,100. Just bring everything else down because nothing happened. 9,500 comes down, and now we have expenses here of 1,400. Part D. The company collected $1,000 cash as a partial payment for the amount owed by the client in transaction B. In this case, we are receiving cash. Why are we receiving cash? It's because in Part B, we made a sale and someone owed us money. They owed us $4,000. We put that in as account receivable. Now they're paying us some of that. Do they still owe us $4,000? No, they only owe us $3,000 now because they're paying off $1,000. I'll show you how this is done in the chart. In this scenario, we are receiving $1,000 cash because they owed us money. The accounts receivable of $4,000 now gets reduced by $1,000 because they no longer owe us the full $4,000. Nothing else gets touched here, but the equation still works even though it's all on the same side. 1,000 minus 1,000 is 0. So this still works. Let's total everything up. 4,100 plus 1,000 is 5,100. 4,000 minus 1,000 is 3,000. And this makes sense because our accounts receivable, we are owed $3,000 now. They paid off 1,000. The rest are zeros for now. And then revenue, we'll just bring that down. Same thing with expenses, just bring it down. Okay, last one. In Part E, the company paid $700 cash for this period's cleaning services. What's one account that's affected here? Cash, right? We are spending $700 cash, and what are we spending it on? Cleaning services. What would cleaning services be? It would be an expense. To fill in the chart, we would subtract $700 from cash, and we would input $700 into the expense column. Negative 700 equals negative 700. Now let's total everything up. 5,100 minus 700 is 4,400, plus 3,000 equals 7,400. Now this side has to also equal 7,400. We have 0 in these accounts. 9,500 minus 2,100, that's a total of my expenses, equals 7,400. The equation still works. I know this can sometimes get a little confusing, but we're not going to be using this whole chart and transaction analysis after chapter 1. This is just to help you get started thinking about the different accounts that will be affected and how it affects the accounting equation. Starting in chapter 2, we're going to move directly to journal entries and you won't have to fill in this chart.